Hey everyone, welcome to the Kendall Report. That was interesting. Just as I was about to start, I have an electronic device that I do my notes on, and the battery went dead, but it is back up, so I'll have to look at it from an angle. Anyway, welcome to the Kendall Report. Make sure you hit the like button. Today was quite the day, huh? Somebody said they didn't expect to see the market reverse like that, and it was interesting because it looked like S1, S2 was going to hold, and then it was R1, R2 was going to hold, then it was R3, and then it was RXT, and that didn't hold, and we just continued to move beyond. So we actually did get a RTX sell signal, so we should get possibly a day or two sideways. But I realized getting caught a little bit in this squeeze today that there was something going on. What it was a quarter end window dressing. All of a sudden on Tuesday, it was like there was just this relentless bid that wouldn't go away. It just kept grinding higher. And those of you who've been in, use the indicators, looking at the webs were in a rope on a 5-minute chart. They just continued to follow that all day long. And it was very interesting session, to say the least, but it just kept grinding. I'm thinking, what is going on? What is actually out there, which was nothing. Although there was a fair amount of interesting things that were released today that one could argue that we're getting, I guess, more robust signals from the markets, from the economy. Those folks that were talking about a recession, and even as we come into July and we come into the third quarter, maybe it'll get more interesting. But new home sales up 12.2. They weren't expected anywhere close to that. Case-Shiller index did drop on 1.7%, but we're looking at consumer confidence came in at 103.8. It was expected to be around 102.8. So that was better. And durable goods was expected to be a negative number. It was up almost 2%. So there's something going on, folks, and it's not negative. And there continues to be just this underlying bid in the markets that we saw. But really today, I think it was probably a one-hit number. I talked to you about last night that around 44.16 we should see some sort of rejection. That should have been the ceiling. Well, we printed all the way up into the 25 handle, and we're back around that 13 handle right now. But the point is that we're really just seeing this continuation of this pattern. And I was looking at, there is a long signal, maybe I'll bring it up on TradeStation here tonight to show you, that's been long for a couple of weeks now on the S&P, specifically on the E-minis. So that is there. So somehow we ended up today, S&P up 1.5, NASDAQ 1.65, and the Russell even caught a decent bid up 1.46. So that was interesting. Tomorrow we don't really get any news, so we'll be operating on, I'm not sure what, maybe most of this rebalancing trade got done today. But this was it was the only explanation that I could find that was like, why was this relentless bid out there? And it was, like I said, it just continued throughout the session. So I just want to address a couple things here as we move forward, because I still am convinced that the Fed is going to raise rates probably in this next July meeting. I think they might skip a meeting, then maybe go into September. I think all they're really doing is trying to slow down the pace of what they're doing. I think they've, I've mentioned this before, I give Jay Powell and them an A+ for how well they've done handling the economy, because obviously. I mean, look at these numbers we keep getting, employment numbers, you name it, whatever metric you want, it just continues to grind forward. And, you know, we're not the UK. UK's got a fair amount of issues there that's going on. But, you know, Europe has always been, if you look, going back even after the GFC and the recovery in '08 and the 2010, if you remember, there was a big snafu in Europe. Some of you are in Europe, and you know there was 2011-12 was a pretty tough period of time. The U.S. kind of stagnated, but it didn't get. It was being more affected by what was going on in Europe at the time. But markets just continued to climb all the way through. If you go from 2010, a couple sideways movements, but for the most part, we just continued to, you know, a higher pattern. And we're not far, folks. We're a lot closer to an ATH, all-time new high, than we are to any low. We're right now at 4,400. The low last October was what? 3,502. We're a long ways off of there. Our database continues to do pretty well, and I'll cover that tonight. And just remember now, the way I'm covering the database is a one-day lag. So if you have Wavetech, you'll know in the next couple hours what the numbers look like after today. And I'll just mention why I'm thinking about it so I don't forget. But if you are on Wavetech and you see there's not a lot of new buys or anything like that, a lot of times what will happen, we had, I'll go through the database, we had a fair amount of sales yesterday, but when we don't get the bounce back, I suspect the database is just going to flatten out here. And I've been talking about that. We'll go into more detail here in a minute. But just know our good friends at the Fed are doing a really good job. I might be the only one that's actually giving them some praise here. Everybody's trying to tell them how they've been behind the curve, they've done everything wrong, all that. You know, they didn't spend the money. They didn't put the stimulus in. I guess, effectively going back to 2020, they certainly cranked up the balance sheet. But since then, all of the expenditures and the things that have really been kicking inflation, they have not been part of. And I think Powell's been pretty solid here, folks. I'm not. I usually, it's fun to be after the Fed chair and tell them what a poor job they're doing. They're not. All you got to do is look around you. You know, go to your local restaurants, and everything's full and everything's working. So I was even on probably a year ago about right now, I was screaming probably with everyone else that, you know, they're going to break something. They're going to keep going until they break something. And I still think I'm going to try to migrate out of this little rant here in a minute, but I still believe what's happening is they are just normalizing interest rates. And I need to clarify that just based on some comments that I've seen on the channel. I want to actually talk just for a minute what I mean when I mean normalized rates. Normalizing rates is letting the market decide what the rates are going to be, not what the Fed is manipulating them to be. And I've talked about this a fair amount off and on, but that means if, with all the debt and everything we have, that if rates need to be 9%, they'll be 9%. If they need to be 3%, the markets will, based on supply and demand and what kind of risk is in the economy, that's how they'll be priced. And this is how it's always worked, folks. It's never, you know, we spent the last, you know, really 10, 14 years at these artificially low rates. If they would have been free floating then, we would have had a much different rate structure. Would things have been better or worse? I couldn't tell you because we will never know that. It's just like if you go back to 2008, if they hadn't bailed out the banks and they let everything fail, would the system just kind of rebuilt itself from ground floor up? We'll never know. They bailed the banks out. So far, I'm sitting here in 2023, amazing as that is, and where the world and the economy goes forward. and this is just how it works. And so just know that even a 6% or 7% mortgage is not a high mortgage. I won't go into the talk of the 80s and all that, but the 80s and 90s were around anywhere from 13 down to 8. But if we go back even further into the 70s, the interest rates have always been 5-7% for the most part. So we're back to that level. And I think ultimately folks will start to rotate and buy new homes for their families and all that stuff. So I still think the housing is pretty much bottom, especially obviously on the new homes. We'll see, we have existing homes coming out. So when that comes out, we'll see what kind of numbers we get there. So let's go ahead and get in. I'll cover the database real quick. Should be another quick video tonight. Looks like I can be pretty efficient here and get through everything. So let's go ahead and take a look at the database. Bear with me 1 second, folks. All right, so this is yesterday's run, and we're at 5611. We were around 62, 64. So we're starting to see that attrition in the database I've been talking about. We did see 1,028 sells for this morning, 216 buys. So we had a negative rotation, and it looks to me that this will continue. Like I said, what you're likely to see if you're a Wavetech user, or tomorrow when I cover the database, is a flat, maybe it upticks a little bit. I don't expect a lot of new buys coming out of today. This was really more of a rotationary market here. I still think we get probably 52-48% out of this. We should still see some backing up of the database, which doesn't necessarily mean there's a collapse in the market. So like I said, I'll show you the trade station so you can see some of the signals that were there. And I've got it set to do multiple signals right now. So I'll show that to you in a minute. But the database is solid. Anything over 42 is good. Right now, after being up to the almost 68% level, you're really looking more at a staying above 48. 42 is kind of the drop dead number. If we go below that, there's materially some issues there. So people are always asking, what percentage are you in cash? We run literally thousands of portfolios every day. And the cash levels right now at this point in time are only about 20, depending on the strategy, about 25 to 30% in cash. And I'm going to go over here and let's just take a look at. This is a pretty good example right here. So right now this is the S&P 500 that we're looking at. This is basically all 500 stocks. Got active 500 symbols. And what we're looking at here right now, as far as the percent bullish at the moment, is we're 69.6% invested. So about 30% in cash, using the S&P as a guide for that. So there's still some cash on the books there, and that is yeah. So that's pretty much all that. There's nothing else there other than that cash level. So if we look at the, I go to the all stats page. This is a thing that I keep emphasizing on the intermediate models, we're really looking at the current duration right now. On the optimized weekly, current duration is 50 days, typical holding 205. So we still have a lot of forward looking from the standpoint of the patterns here. Yeah, you're welcome, David. A lot of times I just can't see the timeline real good. I'd answer more questions, but anyway. All right, let's start with the S&P and take a look at, this is the hourly chart. So we traded vertically up. Every bar for the last 8 hours has been up, including overnight. And now what we're seeing is a bit of a rejection here off of the 200-day. We have the 10-hour moving average coming in here. Look at the algos. The algos are suggesting that we're going to challenge. We'll probably ride along this to probably end up coming back down, into this, probably around 4,200. We'll go through the market grid here in a minute, but on the hourly, it looks like we're getting at some kind of peak here, at least from that standpoint. The PPM1 is at a 0.88, so this is a very bullish number. So that's likely to hold. So the support right now is going to be around the 09 level, something like that. So let's take a look and go to the daily chart, and I'll do two things here. We'll take a look at the daily. You can see right now we traded below the 10. I thought we might hit the 61 level, and we printed last night. If I get the value of yesterday's low, we printed 43.71. I thought we could see in that 60 handle. It just kind of opened and rallied pretty much straight through the day, as you saw on the hourly chart here. So, but what we're looking at here, market grids turned up. Looks like from a market grid standpoint, we're looking at right now, get these numbers for you. R1 is 44.29. That would be a slightly higher high. We're looking at S1, 44.08. That's about where the hourly chart suggests we're at least initially bottom. And then around 43.96 is S2. So we definitely inverted this. The question is, can we actually start to move this market higher from this pattern? It looks to me the algos are still have some upward bias. I told you that there was going to be a tradable bounce off of the 21 period moving average. That's what was setting up. We didn't quite make it there. We came a little short of that. Yesterday, that number would have been 43. That was 40. If you recall, I was talking about 43.60 rough numbers. 43.60, 43, 45, 43 would be the perfect place for a bounce to occur. And so we got a little bit of that. So right now we'd look for at least an 08 possibility of getting down just below 4,400 back to 93. So it should stabilize around there. Yeah, and all of the PPMs are continuing to suggest that they're going to are negative. So I think we still, probably the most likely scenario is getting sandwiched between the 10 simple average 10-day and the 21, and those values right now are 53 and 44.20. So we should stay around that. I really thought we would see some sort of rejection off of 16, but like I said, the only thing that explains the type of buying that was going on for no obvious reason was a bunch of quarterly rebalancing. And, it seemed obvious if you did it on Thursday or Friday, but Tuesday, what a great day to do it. Was it turnaround Tuesday, right? So that was definitely in the cards for today. So let's take a, let's just, we'll finish here and we'll go through the NASDAQ and the other markets. There's really not much more there. One of the things I did tell you I'd show you here is the trades, and where this trade came in at 43.32. There were I've got this set so we'll do multiple buy signals here, and it's still long this trend that's coming up, and the 21 period moving average is going to be the key to this trade here. If we violated that, it looks like then we would probably get an exit from this trade. But for the moment, that 21 is still pretty solid. I'm just going to go back to trading view here, and that 21 right now is still got a 0.21 level. So, but it looks like it's going to tick up for a couple of days, but it's going to ultimately start to fade. So I still think that even though there was a bounce yesterday, that we end up seeing something toward the below the 21, possibility of getting below the 40, and those values are 43.53 as I mentioned on the 21, and a 42.50 would be a move down to the 40. We may not get that much weakness, and I was looking at the weekly market grid, and we were trading, I believe 29 is like R2 on the weekly. Matter of fact, let's just take a quick look at that. R2 44, 44.15, R1 here on the weekly. But look at the probabilities for the current 10 period moving average on a weekly. Only has, it's 78% chance that it will hold. It's very, very strong in this trend, and that is all the way down at STX level, which is 42.78. That 10 period moving average is 42.78 exactly. So it's interesting that that line is running right at the extreme. I don't see us getting there, but it'll be interesting to see how the rest of this week trades out, especially if the window dressing, most of it was done today. Yeah, so I'm going to answer a question while I'm here right now before I move on. I just see somebody wanting me to elaborate more about this quarterly redressing or this rebalancing. A lot of the big mutual funds, ETFs, all these folks, they'll change some of their allocations right here at the end of the quarter. Sometimes it's a little catch up, some rotation. That's what we see, by the way, in the database from. When we're looking at the database, that we'll get this rotation where that's what the short-term rotation is going on on the dailies right now, where you get up to around 68%. Like I said, we should stay 48, 42% on the database. It shouldn't go much below that. Yeah. All right, so let's get into the NASDAQ. I'll stay with this weekly for a minute, but look at this 90% probability for the NASDAQ to stay above the 10-week moving average. Pretty insane. Matter of fact, 10, 21, 40, all 90%. I mean, this is a screaming trend, folks. These things just don't end overnight. So it looks to me, whether or not we can go all the way over here and print up into an all-time high. Let's see, that was 16,676, looks like, on November 22nd last year. But if we can get last year, let's try that again in 21. And so the algos are suggesting that it's just going to go up. When I'm anxious to show you folks, and we are believe it or not, in the final run of finishing the new indicators. There are actually 9 of them, including 2 signal-based. There's a trend scalper and a couple other things that I will be revealing to you here very soon. But these algos running, it's interesting. I've been, and I will show you this in a live session sometime soon in the next, let's say 3 to 5 days, in that running a, believe it or not, a 5-second chart with the probabilities and with the algos on there was very interesting today, what was happening. I'm anxious to show you. It was very insightful and very frustrating if you happen to be short getting squeezed in this rally today. Yeah, we're thinking maybe the end of the week, Friday. Mason's busting tail right now, trying to get some stuff done. I've got my stuff. The main thing I've got to get done for you folks is the video, so you understand what they are. Got some of those done, not all of them. So it's coming together. So let's go to the daily here on the NASDAQ. We traded. Matter of fact, we did get the bounce. It's frustrating, especially sitting here right now, that intraday, this was not a trigger point for me personally. And that, look at the low was 14,862, 14,823. So we got really close to that 21. I told you it'd be a bounce off of there. But look at these algos on PPM 1, 2, and 3 here. They are just, at least 1 and 2 are continuing to stay, are fading. So the fact is that we traded back up to the 10-day moving average. Like I said, we'll probably get sandwiched here between the 21 and the 10. Expectations based on what the algos are saying is that we should see maybe some downside and still potential if we get through that 21, that we see the 40. But remember, the 40 is rising, so it's coming up every day. Yeah, so just keep that in mind, that we're probably going to see some sideways movement here from that standpoint, and we should see, like I said, little downside, at least retest this 21, and depending on the configuration of the PPMs at that time, there's a very good chance I think we're going to break through. It doesn't look, like I said, this does not look like the place where we scream out into new highs. Looking at that weekly chart, that 10-week moving average is quite a ways below, or a fair ways above that number. So that is suggesting we could pull back towards that. That's closer to where the 40 is, by the way. So matter of fact, I'll just show you that value real quick. The 40 right now is 14,236. We go over to the weekly 10 is right now 14,292. So they're going to be very similar. So that move down to the 40-day moving average or the 10-week average is going to be the point where that will be a pretty decent buying opportunity. Again, should bounce fairly strong off of that. But even then, if we get down that deep into this pattern, then we should see more consolidation, especially as we come into July and beyond. That looks like exactly what we're going to get. All right, so Russell rebounded, as I mentioned, as well. We're off a little bit in spite of the algos are still looking pretty down. It looks to me, and I've been talking about this for days, is that the Russell has been leading all of the markets kind of in direction. It hasn't been leading in performance, but it's been leading in direction. So we've had multiple days down. Looks like this 10 period moving average is down 0.18 right now. So, and it's showing that it's going to at least stay at that level, accelerate. That's just below trend level. 0.25 minus 0.25 or greater is trend level, but that's enough to really present a lot of resistance. So expect for the market to re-challenge this 21 at 1854 and get through that. Then probably looking at some numbers down into the grid. But you see that the PPM2 algo is turning south pretty decent. In fact, it's suggesting that we're going to get almost in the trend phase down. So what that means, anytime you see the PPMs like that, those of you that have the indicators, when you see that like that, that means the market has to remain below that value of the 21 to keep the algo to be right and for the moving average to start to drop down. And as long as you're below that level, then you're going to see that deceleration, in this case, and a potential acceleration downside, because PPM2 is still in trend mode up here. So we're at 0.22 positive. So it's still got some support factor there. And so probably looking at the market grid when you see something like that. Right now, the 1873, we're looking at our probably S1, 1857, 1847 should hold this. So we'll see what kind of numbers come out of here. All right, so we'll get into treasuries next. And somebody's telling me about home prices in 2007 and the difference now. No, I get it. People make a lot more money than they did in 2007 on average as well. So there's a balancing effect there. And like I said, I had a 13.25% interest rate on a $240,000 house in California in 1983, I think it was. I bought that place. So it works. All right, so we're on the treasuries here, and treasuries uptick again. 10-year back to 77, 76, closed right at 77, 3.77. We printed down to 69.20, so we got another bounce off of here. Been talking about, I'm going to take these probabilities off for a minute, but I've been talking about how we're just going to remain in this range, and I've kind of locked it down at the top end around 380 and 360 on the downside. We're still going to chop around. I wouldn't be surprised to see that pull back in a little bit over the next couple of days. This is the daily chart, and I've shown you the weekly chart as well, and it's just really even more so. Let's take a look at the 2-year. I have been saying the 2-year should continue to track this 10 period moving average. The PPMs are just completely flat. The projections for them are completely flat. So it just looks like it's going to continue to roll along this line. It does suggest, though, and I have the algos on the SMA on the Wavetech AR predictions on the SMAs. They are showing that they're rolling over as well as we go forward. And it's a long ways out. I think I've got these 50 right now, 50 days out, and this will change a lot. But you can see the trajectory, at least where it's going to climb up. We should stay somewhat stable here, and then maybe as we get longer down down the road a little ways, we'll see some downside. But there's really not a lot of downside in these markets in the interest rates. Powell is telling you that. People don't want to listen to it. You hear a lot of folks talking about what the market is pricing in, and I'm also telling you that that's how the markets will work going forward, is that they'll price it in, and we're just seeing continuing to climb on a relative basis here. And I'm still going to argue probably till the end that the inverted yield curve will have very little effect on any recessionary prediction. And I know a lot of folks are banking on that. A lot of folks have been banking on that, have been sidelined in the markets, or negative or worse. And it's a tough ride. It's a very long ride to get out there on that one for sure. Been talking to you about the crude oil continuing in this downtrend, and this is the daily. You can see it's very pronounced. See the angle here is very much suggesting that we're going to get that down. I'm going to switch these future bars out to 50. I should have done this earlier, but we'll do it right now. I just want you to see something here. Let me just switch this to 50. One last one here. This will reflect what the Wavetech predictions are doing on the SMAs. You can see how everything's very flat but negative. They're just maintaining this slight negative slope. And I don't have the, let me put up, and let's go and put the fib projections here. I'm talking about this. So 67 is going to be 67.36, 64.42, 62.60. These numbers are probably potentially this fib target 2 is in play here. And these trends are very much going to keep pushing things down unless we can get some stabilization, and that's going to take multiple days for that to happen. I'll go over to the weekly because I want you to see this gets way more negative on the weekly. The trend is pretty pronounced here on the downside. So who knows? Maybe down the road, this is the disinflationary force that's out there that's going to keep pushing things down. And Paul and the boys are watching this, and it's going to be I think I'm going to go 6 weeks before we even have a chance at bottoming here. We're going to see at least another four to 6 bars. The best thing you could hope for if you're in the oil business is that this thing starts to bottom here and starts to turn around. It doesn't look like that is going to be very likely, at least at the near term. All right, we'll go to gold, and gold has similar type pattern. We are trading right at the fib target, low 919. This is the weeklies. I'll go to the daily here in a minute, but the weekly algos are suggesting we're going to continue to decline. I still think we see an 18 handle of some sort, 1860, potentially 1840 on the downside. This just looks like this thing is rolled over pretty good. So like I said, just wait for the if Peter Schiff tells you to scale in, there's still more downside. Just remember that. Let's look at the daily real quick. You can see how this trend is just not going away. It looks to me that we're going to continue to grind, and this is a really choppy sequence. There's no real big acceleration here. It's just a steady grind. And like I said, maybe even if you look at where these lines are all projected to cross down the road, which is probably 20 days out in the future, that's right at 1870. I wouldn't be surprised if we just drift into this pattern that's being projected right now. All right, final market, Bitcoin. Yeah, you can see this is the daily Bitcoin just exploded here. Now Fidelity, BlackRock, everybody wants to have a ETF for Bitcoin, and Bitcoin's managed mainly because it's not crypto. It is a commodity. So it is managed to, I guess, get the blessings indirectly of the SEC and the mainstream. That be good or bad, that's what appears to be happening. And it's maybe some crypto assets will be legitimized. I don't think so at the moment. It looks to me, one of the things we're getting here on just on a daily is we're getting this contraction. And typically when the market grid contracts like this, it indicates that we're going to get some downside. You can see the angle here of attack is still pretty strong. We're at a 1.41 ppm1, ppm2 is 1.46. But what looks like is going to happen, and that's going to start to fall apart here over the next maybe 3 to 5 sessions, and we probably roll down into the 21 period moving average at that time. Let's take a look at the weekly. And this is all that the daily is telling us that we're most likely going to challenge back to this 10-week moving average. And look at the slope that's being projected here. So I think Bitcoin looks pretty good. Maybe they're going to get these, there's going to be an announcement with SEC, and that'll be enough for everybody to kind of come in and talk about Bitcoin and buying ETFs and getting involved. So maybe that does open a broader market. We'll see what happens. And I know people that we know on the institutional side, some of them, not a lot of them, but some of them do want to be able to embrace Bitcoin. So maybe that will give them the ability to do that. Okay, folks, this will do it for today. I appreciate you coming. Evidently, somebody says, ignore the haters. I always do. Although I love the haters. The trolls make things happen. They bring stuff, they bring goodness as well. So don't be, embrace them as long as they're not being obnoxious, then that's different. Anyway, folks, hope hopefully you enjoyed today's show. I think that it's going to be interesting to see if not we finish this window dressing. I'll talk about it tomorrow more, but it's just simply a rebalancing of the books by these institutions, which are mutual funds, ETFs, and any of these big pension accounts. Everybody gets into this game, and it happens typically at the end of the quarter, and they always sneak up. Sometimes it's a Thursday. Today it was a Tuesday. We'll see if they continue on. Anyway, folks, thanks for watching. Have a great evening. We'll see you tomorrow at the same time.